So I'm the lead manager on the investment trust and the open-ended version special situations. I've been doing that for just over 11 years for the trust, and we've just gone through the 10-year anniversary on special situations as well. Overall, I've been at Fidelity for just over 20 years now, and previous to running these funds, I was an analyst at Fidelity. So I've got what you'd call a value contrarian process, which I think is quite differentiated from most of the funds in the UK, particularly some of the bigger funds, which are run on a much more sort of quality growth basis. So if you look at the available universe, there's about 240 funds you can choose from in the open-ended space, and there's probably only about 10 value funds. So I'd say it's quite differentiated from the average UK fund. And what value contrarian means for me is looking at stocks that we think are worth more than you have to pay for them today. So effectively stocks that are worth less than intrinsic value. And generally the reason they're trading how they are, so cheaply versus their value, that's because there's some kind of issue that is clouding people's judgment and stopping them paying a fair price for these businesses. So often companies that are having a short-term issue or in an unfashionable sector. And so very much looking for things out of favour that we think through our holding period are likely to come back into favour over time and be worth much more than they are trading for today. So the great thing about the Fidelity organisation is we've got a very large buy-side research team. So I think the largest still in London. So over 150 people looking at stocks globally as an analyst. And they feed up ideas to the fund managers at Fidelity. So we have real waterfront coverage of the stocks quoted in the UK, and they can really be sifting through the markets, looking for things that they think are interesting but not appropriately valued. And so it's very much this team that gives me ideas, and we work on the stocks together. Typically I'd buy into things gradually, and maybe over as much as a 6-month period in terms of buying something new, and a typical holding period would be about 3 years in the fund. So we're not looking to buy and hold forever. What we're looking to do is buy something when it's cheap, hopefully that over time that cheapness works out of the stock and it outperforms, and then we look to recycle money into new ideas, and typically that takes around 3 years. So very much the idea of this fund, because we are changing the positions over time, we do want there to be change in the market. So we want there to be volatility in economic and market conditions, because that throws up opportunities. So the fund tends to do best when there is this volatility in markets. It tends to do badly when markets are steadily trending one way, be that steadily trending up or steadily trending down. And particularly I'd say markets which are steadily trending up are much more difficult for the fund. And there you would tend to see more sort of growth funds outperforming. Whereas when there's volatility and uncertainty, that's when we get the opportunity set to find ideas, and that's where we typically sort of outperform, particularly when there's recoveries from these periods of uncertainty. That's the best environment for the fund.